Have you ever been scrolling through the financial news and seen these screaming headlines about a super tight oil market, prices are about to go to the moon? But then the actual data, the real world stuff, seems to be telling a totally different story. Yeah, it's pretty confusing. The global oil market right now is sending some seriously contradictory signals. So, okay, let's get into it and figure out what is really going on. So this is the big question, right? How can one corner of the market be yelling about tightness and shortages while another part is quietly signaling, hey, we've got plenty of oil over here, demand is kind of weak? This isn't just a small difference of opinion. It's a major disconnect between what the financial world thinks is going to happen and what's happening on the ground right now. To really get this, you have to understand the market's current paradox. Think of it like you're watching a split-screen TV. On one side, you've got this fast-paced movie with traders and futures contracts, and on the other side, you've got a documentary about oil tankers and refineries. Two completely different stories playing out at the exact same time. And here's that paradox in a nutshell. Those financial futures contracts, the prices you hear quoted on the news, they're pricing in future worries, things like geopolitical drama, potential supply cuts, you name it. But the spot market, where actual physical barrels are being bought and sold for delivery today, well, that's reacting to today's logistics. And right now, that means plenty of supply, storage tanks are looking pretty full, and refineries just aren't all that thirsty. So, the reason for this whole split-screen reality is that we're not actually talking about one single market. We're talking about two separate but totally connected worlds, what we call the paper market and the physical market. And if you can understand how these two work, you've got the key to decoding what's happening. Let's break it down. The paper market, that is all about financial bets. It's full of traders, hedge funds, but also big companies that are just trying to hedge their risk. They trade futures contracts, which are basically agreements to buy or sell oil at a set price on a future date. The physical market, though, that's all about logistics. It's where a real company needs to get a real tanker full of crude oil from, say, Texas to a refinery in Europe. One world is about finance, the other is about literally moving molecules. And just look at this number to see how massive the paper market really is. For every single barrel of oil the world actually uses in a day, almost 30 paper barrels are traded on financial exchanges. It's just a staggering amount. And it shows you how financial feelings can, for a while at least, totally drown out what the physical world is trying to say. Now this here shows how all that paper trading eventually hits your wallet. A price move on the NIMACs, that's the big paper exchange, it sets the mood. That feeling then flows down to the physical spot market, then to the wholesale market where gas stations buy their fuel, and finally, right down to the price you see at the pump. So yeah, it might start as paper, but its impact is very, very real. So you might be wondering, how did this giant, powerful paper market even start? Well, it wasn't just built for speculation. It was actually designed to solve some very real problems that existed in the physical oil world. Let's take a quick look at how it all came together. The whole thing really got going in 1978. But the 1980s, that's when the NIMACs really blew up. You see, before that, oil pricing was this murky business controlled by just a handful of big companies. The futures market brought everything out into the open. Suddenly, anyone could see what a barrel of oil was worth in real time. And today, it's this massive global electronic system that is the foundation for how we price fuel all over the world. And it's not just a casino for speculators. The futures market has some really crucial jobs. It gives us that price transparency we just talked about. It lets an airline or a trucking company lock in a fuel price to protect themselves from sudden spikes. That's called hedging. And a really big one, the exchange guarantees all the trades, so you don't have to worry about the other side backing out. These things are absolutely vital for the real-world energy business to run smoothly. Okay, so with all that history and the mechanics in our back pocket, let's bring it back to right now. How can we use what we know to make sense of these mixed signals the market is flashing at us? This slide really lays out the disconnect with cold, hard data. So let's walk through it. First, look at Brent futures. The paper market is in what's called backwardation. That's a classic signal of a tight market. But in the real world, actual barrels of crude from the North Sea are selling for pretty weak prices. Okay, next, gas oil, that's basically diesel. The paper cracks, which are a measure of refinery profits, are looking strong, suggesting shortages. But again, actual physical barrels of diesel are selling at a discount. You see the pattern? In every case, the paper market is pricing in strength that the physical market just isn't seeing. And let's quickly nail down those terms. Backwardation is when the price for oil delivered right now is higher than for oil delivered in the future. It's the market screaming, I need it now. Contango is the exact opposite.
It signals an oversupplied market where there's no rush to buy, because everyone thinks there'll be plenty later. The shape of that curve tells a story. And that right there, that is the core of the problem we're seeing. The paper market structure, this backwardation, is telling a story of tightness. But that story is completely contradicted by the oversupply and weak prices we're seeing for actual barrels getting loaded onto actual ships. One is pricing in future fear. The other is pricing in today's reality.
So the big question is, what happens next? A disconnect this wide can't go on forever. Sooner or later, the financial world has to line up with the physical world. So here's what the pros are watching to see which side is going to blink first.
If you really want to follow this, you have to look past the headline price. These are the indicators that matter. The WTI Brent spread, for instance, tells you how U.S. crude is priced against international crude. Those crack spreads, they show you how profitable it is for a refinery to make gasoline or diesel. These are the numbers that reveal the true health of the physical market, because they measure the real-world economics of moving and refining oil. At the end of the day, three big, real-world things are probably going to settle this standoff. First, just how much refined fuel, like diesel, keeps flowing out of Russia. Second, how smoothly the world's refineries get back up and running after their regular maintenance shutdowns. And third, what those physical premiums we just talked about do next. These events will eventually force the paper and physical markets back into the same story. So what's the bottom line? This is a temporary situation, but it's a really significant one. The big takeaway here is that you absolutely have to watch both markets. If you only look at the financial headlines or you only look at the physical data, you're only getting half the picture. And right now, those two halves look like they come from completely different puzzles. And all of this brings us down to the one single most important question. Which market is telling the truth? Is it the paper market that's pricing in all this future risk? Or is it the physical market, reflecting the oversupply that we can see today? And answering that question is so important because while financial sentiment can push prices around for weeks, even months, market fundamentals, the actual real-world balance of supply and demand, they always win in the long run. History shows us that these disconnects always resolve, and sometimes they resolve in a pretty dramatic fashion. Figuring out when that turning point is coming, well, that's the whole ballgame.
This is not financial advice.